a lot of times they're re-injecting those proceeds right back into the business to grow it further. And from a buyer standpoint, from our view, we love it because the idea of stagflation is very much top of mind today, where you have flat or slightly increasing rents, but you also have expenses that are increasing at a higher rate than your revenue because of inflation, right? We've all seen that. You've seen it.
So talk about other creative ways that you're structuring deals to make it a win-win for the seller when they exit.
Yeah, I mean, sometimes there's assumable debt, Brett, which is helpful, of course. Those deals are harder to find. One of the things that comes to mind that I think is worth sharing, is an asset class that we've been investing in through 2023, triple net or absolute triple net industrial sale leasebacks. So a bit of a mouthful, but essentially we found this sector to be quite appealing for a couple of reasons. But before I get into that, like, what is it? So you have typically a manufacturing business that owns and operates an industrial building. And a lot of times they're getting acquired by private equity companies. But the private equity company doesn't want the real estate. They're acquiring really the operating business. And so they'll sell the real estate and continue to occupy the space and the real estate as a tenant. So what you have here is a situation where if you're acquiring the real estate, usually you'll see 20-year leases put in place with escalation clauses on the rent. So the rent goes up every year between 2 and 4%. That's part of the lease. And it's absolute triple net. So the tenants have to pay for all the expenses, the property taxes, the insurance, repairs, maintenance, utilities, etc. Why is that appealing today? Well, for us, you asked it based on the seller, but the seller is looking for a capital injection. They're looking to get rid of the real estate as a part of their balance sheet and just have the business. A lot of times they're re-injecting those proceeds right back into the business to grow it further. And from a buyer standpoint, from our view, we love it because the idea of stagflation is very much top of mind today, where you have flat or slightly increasing rents, but you also have expenses that are increasing at a higher rate than your revenue because of inflation, right? We've all seen that. You've seen it. Utilities, payroll, taxes, insurance have all gone up drastically in the last couple of years with inflation. And so to combat the idea of stagflation, where your net operating income is essentially flat or declining, these types of assets help out very much so in a portfolio because you have growing revenues with rent escalations every year and zero expenses. And so we love that as a part of a portfolio and a part of an investment strategy.
Got it. Let's walk through that for a second. So what's the average cash on cash return for that if someone were to buy it for, all cash, 5 million for one of these?
Typically it's between 7 and 8% year one.
Excellent. And then is that taking on debt or what's the cap rate?
Yep. Cap rates, I mean, they've expanded a bunch in the last couple of years, Brett. Again, why we think it's a good time to buy. But we've seen on some of these deals over 200 basis points of cap rate expansion, where you're going from maybe it was a 6%, now you're getting it an 8%, that kind of thing. And then borrowing rates have ranged between 5 and 7%.
Okay, excellent. And then are you buying are these already existing businesses that are existing buildings that have been around for 20 years? Like, what's the average age of these? Just kind of curious on that.
Yeah, it's right around there, actually, 20 to 30-year age buildings. But again, industrial, they've been occupied oftentimes by the same tenant for many, many years, and they're going to continue to stay there. So you have 100% occupancy at time of acquisition.